Partnership. Let's look at the definition of partnership. Now, this is when two or more people come together to achieve a particular objective. In certain jurisdictions, there is a limit or a ceiling as to the number of people that can marshal forces for the achievement of an objective. Now, the purpose for which they team up resources must be for a business arrangement, meaning they must have an aim of achieving profit. Let's look at certain features of partnership. Now, it is unincorporated. Partnership differs from sole proprietorship in terms of the number of owners and management. And apart from that, it is not deemed as a separate entity from its owners. So the people who come together to form a partnership are called partners. In the eyes of the law, it shares an identity with the partners. Now we have what we call the reporting entity principle, which means that in as much as by law, the partnership doesn't differ from the identity of the partners, it is prudent to separate the affairs of the partnership from that of the personal activities of the partner, that is the owners, in order to be able to determine the true performance or the account of performance of the business. We also have a situation where the partners have unlimited liability, which means that the partners have responsibility to settle any debt that the partnership incurs, even if it means they have to fall on their personal belongings or personal earnings. So if one has funds that they have saved from their childhood before they establish the partnership, they will have to fall upon that in case they need to settle a liability, especially in terms of bankruptcy. Let's look at some partnership terms. The first we'll look at is appropriation of profit. The profit that is seen when we normally calculate profit or loss is different from what the partners will share. So whatever money that is paid to the partners will not be captured as expenditure in the preparation of the profit or loss. So after the profit of the partnership has been estimated, then some entitlement will be paid to the partners per an agreement that they have consented to. So per the agreement, there might be the need to pay salaries because there might be some partners who are involved in the routine management of the partnership. And again, this will not be part of the expenditures considered in computing the profit for the year. So after the profit has been gotten, then we will now pay the salaries out of this. Secondly, partners might be paid interest on their capital to serve as a reward for foregoing certain use of those resources and investing in the entity. And there might be some interest on drawings. Any money that is taken out of the business is basically deemed as the capital being washed away, and it might deprive the partnership of some juicy opportunities. So in order to deter partners, there will be an agreement on how much interest they will pay whenever they do so. Then when all agreed monies that are supposed to go to partners have been taken out of the profit for the year, the profit that will be left will be called the residual profit. So this is what the partners are going to share as their returns from the business. So in terms of limited liability, that would have been deemed as the dividend. The share of the residual profit will be based on an agreed ratio. That is what we call the profit sharing ratio. In situations where the appropriation, so salaries, interest on capital, interest on drawings, exceeds the profit for the year, then it means that there will be a residual loss, and that will also be shared based on the same ratio. So in terms of partnership, the partnership does not pay tax. What happens is that tax is applied on the partners individually. So whatever money that goes to them, if they took salaries from the business, if they enjoyed interest on their capital, if they were charged interest on the drawings, they will estimate that, and the tax will be suffered at an individual level. Let's discuss capital and current account. So capital deals with the initial contribution that the partners put up for the establishment of the business. Then current account deals with any amount that is geared towards the partner's earnings. The capital does not change. The current account keeps changing because anytime a salary is paid to the partner, it gets recorded in the current account. Anytime they enjoy an interest on capital, it will increase it. Anytime they share residual profit, will also get increased. Now, in actual sense, the capital should be the sum of the initial contribution and all monies that are enjoyed by the partners. But in real practice, we separate the two. When a new partner is admitted, initially they were, let's say, 5, and there is the need for additional capital to be raised. And because it's an unincorporated entity, they are restricted in the medium through which they can raise funds. So they can't go to the public and float shares. So the best they can do is to open doors for new partners to join and contribute. So when that happens, it is literally like the partners selling off a bit of their business to make way for the entry of new ones. So there will be a need for the sharing ratios to also be amended. If initially they were sharing ratios equally, when the third or fourth or sixth partner joins, they have to sit and now determine what will be the profit ratio. What happens when a loan is received from a partner? So this will be treated as if the loan came from an individual who is not a partner. So what will happen is that there will be a liability recorded for the loan. So if the loan came from Ian, who is a partner, there will be a liability created in the balance sheet for Ian, and then cash or bank will be debited depending on where the loan was placed. The interest that will be paid on the loan to the partner will be recorded as an expense in calculating or arriving at the profit, because you are treating it as if it came from a third party. Let's test our understanding. Ian and Eliana are in partnership sharing profits in the ratio 3:2. The partnership profit for the year was $100,000. The partnership agreement provides for interest to be paid on the partners' opening capital balances at a rate of 5% per annum. Interest on drawings will also go at a rate of 10% per annum, and partner salaries of $25,000 for Ian and $20,000 for Eliana. Now during the year, Ian's drawings were $20,000 and that of Eliana's was $25,000. Now at the beginning of the year, the partners' capital and current account balances were: for Ian, $120,000 for capital and $16,000 for current; for Eliana, $100,000 for capital and $10,000 for current. So we are supposed to prepare first the partnership appropriation account, calculate each partner's share of the residual profit and total profit share, and then prepare the partner's current account. So we made aware the profit that the business generated. We are told it's 100,000. So in terms of appropriation, we are not going to share the 100,000 by first taking away the agreed disbursement. So we are told that there were agreement for interest on capital, interest on drawings, and salaries to be paid. Okay, so we start with the appropriation account. We'll start by crediting it with the profit for the year. Profit for the year is an income. Incomes have credit balances, so we bring it here. Then we will debit it with the salaries because that is what we are going to pay it from. So we debit it to reduce it. The salary totaled 45,000. That is the 25,000 for Ian and 20,000 for Eliana. Then we're told there were interest on capital to be paid, which will total 11,000. Also supposed to come out from the profit for the year. Now the capital, when worked out, is 6,000 for Ian, which is the 5% of Ian's 120,000 capital, and 5,000 for Eliana, also 5% of 100,000 capital invested, the total of which led to the 11,000. And there will also be an interest on drawings. Now, the drawings will be a plus to the partnership because it is being received from the partners. So it will increase the balance on the appropriation. Okay. So the drawings will total 4,500. So that is 2,000 for Ian. The 10% agreed to be charged and he withdrew 20,000. Eliana withdrew 25,000, 10% of which will lead to 2,500. That summed up to the 4,500. So now, when we close off the account, we are going to sum both sides. We have had a lecture on how to balance and close accounts. Kindly visit our lecture via the link displayed on the top right corner of the screen and get yourself appraised with it. So we have to sum both sides. The debit side, which is the left, will provide an amount of 56,000, while the right will provide a bigger figure of 104,500. So we will put the bigger of the two sums in the lines below. Then we will find the difference between the balance at the bottom and the sum of the debit side, which will give us 48,500. So because the profit for the year and any inflow, which in this case was the interest on drawings, was more than the agreed disbursement, there is now a residual profit. Now this will be shared as the returns from the investment that they have made. Now when we come to the share of the residual profit, we are told they are going to share the profit in a ratio of 3:2. Now what you need to know is that the first partner to be mentioned is entitled to the first number of the ratio, and then the second will be entitled to the second one. If there are 3 partners, the first will be entitled to the first number in the ratio, the second will be entitled to the second number, and the third will be entitled to the last number. So Ian came first, and 3 is the first number in the ratio. So Ian's share will be 29,100, which is 3 divided by the sum of the ratios. So 3 plus 2 is 5, which will be the denominator, multiplied by the residual profit. Then Eliana will also get 19,400, which is the second number, 2 divided by the sum of the ratios, 5, multiplied by the residual profit. So that will lead to the residual profit. That's how we splitted it. So we come to the total profit that is shared. We are now going to sum every amount that went the way of the partners. So we'll start with Ian. He enjoyed a salary of 25,000 that we saw in the appropriation. He also earned an interest on capital 6,000 and suffered an interest on drawing, so we deduct it 2,000. And then the share of the residual profit is 29,100. So it means that for the year under consideration, he earned 58,100 from the partnership that he invested in. When we come to Eliana, she also enjoyed a salary of 20,000, interest on capital of 5,000, suffered interest on drawings of 2,500, which were less, and a share of the residual profit of 19,400, which means that her earnings from the business or from the partnership under the period under consideration is 41,900. Now, when we come to the current account, Ian had an opening of 16,000 for the year, and he has earned a total profit of 58,100 from the business, which means that his balance on the current account will be 74,100. Okay, which will carry to the subsequent year to be the opening. Eliana also had an opening balance of 10,000 and earned a total amount of 41,900 from the business in the period under consideration, which will render her current balance to be 51,900.